Good afternoon, everyone, and thank you for joining Keeping It Simple. My name is Eric McCardle, and I'm excited to introduce today's guest, Dean Curnutt, founder and CEO of Macro Risk Advisors and host of the Alpha Exchange podcast, which is fantastic, and I recommend you go check it out after this. Before I pass the mic, I want to remind everyone that this conversation is intended to be entertaining and insightful, but it is not supposed to be construed as investment advice. And with that, I'll hand it over to you, Mike.
Fantastic. Eric, thank you very much. And Dean, thank you for joining us. As Eric mentioned, Dean is the founder of MRA, which is one of the options specialist shops on the street that I've interacted with and worked with for a long time. And this is full circle because I appeared early on in your Alpha Exchange podcast, basically talking about how long we've all been doing this. So welcome. Really happy to have you here. And obviously, we're being joined by my grumpy co-host, Harley Bassman. Harley, how are you feeling today?
All's fine, baby.
Excellent. Good to know. Good to hear. All right. So on the agenda today is kind of the discussion on what the heck is happening. That's a technical term. What the heck is happening in the volatility and option markets? Dean, you were one of the very first to start putting together custom indices, looking at things like correlation, et cetera. Now the CBOE and others have begun to augment those. But, coming from a world in which a lot of this data just wasn't publicly available really prior to 2011 to the world that we have today, where Twitter is filled with charts of gamma and skew and everything else. Is 2022 normal in the equity vol markets? Is this something that we should be expecting, or is this really different than anything that you've seen in your career?
Well, 2022 is unique in some ways, and I think what we're seeing is this the prevalence of the up move. Today being just about the biggest one we've seen in a non-crisis period, really of all time. I took a quick look at this. If you exclude the GFC, exclude the pandemic, you've got 6 up moves in the S&P that exceed 5%. Today was one of them. And you made an interesting point, Mike, which was, and I think this is going to be correct, this has never happened when the starting point for the VIX was below 30. The biggest up move I can see outside of a kind of a crisis period was a surprise Feddies on January 3rd of 2001. You guys might recall that. Yep. And today in some sense is almost a surprise ease. It's The data implies something about the path of Fed policy that's extremely positive, at least near term, for the market. So these up crashes at the index level are very interesting this year. Last year was about the up crash via the meme stocks on the single stock level. So these are very, very different markets. Liquidity provision is very unique, and it just leads to very short-dated attention spans and short-dated outcomes, just in terms of price reactions.
Yeah, so let's actually jump to one of the first charts here to illustrate exactly what you're referring to. If we pull up, this is a chart that we put out over tier 1 earlier today. All right, give me 1 second here. Cancel that and do that as a slideshow here. Okay, here we go. Now we're going to get it. So this is looking at the S&P daily moves versus the VIX. So on the y-axis, we have the VIX. On the x-axis, we have the S&P. And exactly to the point that Dean was raising, like, we've never seen a day like this. Actually, just very quickly, we're out here by the close. This was run a little bit earlier in the day. We're like out here versus a starting point in the VIX below 30. We've just never seen anything remotely like this in terms of behavior. But I completely agree with Dean's assessment that this was functionally the way to think about this is that this was a surprise rate cut, right? Versus expectations that were built in. And I think in particular, fears around the Cleveland Fed's median CPI now, right there, or their CPI now forecast, which had suggested that the CPI might come in slightly hot. There was an awful lot of fear, an awful lot of concern, and a general desire to run portfolios that were significantly hedged. I think one of the things that struck me about today was for the size and magnitude of this move, how orderly it felt in a lot of ways, right? Like, it's not like Microsoft and Amazon and Apple basically powered the market higher. Almost everything behaved in a beta adjusted way that would suggest that, like, riskier stuff went up more, stuff that was shorted more went up more. But by and large, this was just an unwind and it would felt like either short covering or index buying or call hedging in a manner that felt very, index driven, I guess is the way that I would put it. Did you see something else, Dean, or would you concur with that assessment?
Well, what I would say is, and I'm sure this will be something we'll dive into, is the sensitivity of the VIX to the S&P on both up days and down days has gotten extremely muted. Yesterday was, I want to say, the fourth time in the last decade actually the fifth time in the last decade that the S&P fell 2% and the VIX failed to rise by more than a point. The other three times are during the pandemic, and I would just say those don't count because the VIX was at 60. Today, and I looked at this earlier in the day, so I didn't get it at the end of the day, but the move down in the VIX relative to, at the time I looked at it, was a 4% up move in the S&P. You hadn't seen that. Typically you get a 4%, 5% up move in the S&P, the VIX just crashes. And I think what's so unique about this is a bear market versus a crisis market. I think that's one way you might characterize it. So if you go back post GFC, even sovereign crisis, you have things like the Brexit referendum, you have China in 2015, you have the XIV event. These are all kind of cliff events that once you got past them and once you felt like the Fed was on your side, the hedge that you owned completely lost value very, very fast, right? So you'd have these spikes up in the VIX, but then they would spike down very quickly. And so I think what makes this just a unique period is it's a long-standing resolution of uncertainty. It just doesn't come and go the same way. And so for the folks that are buying VIX calls, they're frustrated because those aren't working. And you're also just not getting that release of risk premium. It's coming down, obviously, on a day like today, but it's not cratering in the way that we had gotten used to it in the pre-pandemic period. So yeah, it's a different market. The sensitivity of the VIX to the S&P is really low right now.
Can I push back over here on this notion? We always like to say that this is unique. It's extra crazy. There was like this before. My motto: it's never different this time. And I'd say that again right now. I mean, a chart that keeps going around the street is the move versus the VIX. The move at like 150, which is basically astronomical. And then the VIX, I mean, what was it 25, 26, which is basically 10% over its long-term average. I mean, the reality is that the bond market is moving a lot every day. And the stock market is not. Down 20% maybe, but it's been an orderly decline. And if you look at the driver of short-dated 1-month options, historically on anything that's liquid, gold, SPX, FX, bonds, you trade 8 to 12% implied over realized. And that's all that's happened here, is we had an orderly decline and the VIX is trading a bit over realized, and the bonds, it's the same thing. The action's all been the bond market, which is the kind of 3 sigma event. But today, really, is that different? I don't think so.
Well,
I'm going to push back pretty hard against that, Harley, because if I look at even prior to today's move, using exactly the numbers that you're suggesting, the S&P has been trading with a realized volatility over the last 30 days of around 28, right? And so that 8+ would suggest that we should be somewhere in the mid 30s on the VIX. We're at 23.
Oh, there's no question that any one day you could find this being at 120 or at 80. I'm just saying over the course of time, and where the VIX has been over this whole down cycle has not been all that much different than realized. I think the key point is this: it's been, as Dean said, an orderly decline. Today was not orderly, clearly, but it's been relative to the bond market. It's been an orderly decline.
Yeah, I think if you just look at historical percentiles, the VIX is tight to 1 month S&P implied, at the money implied, so that skew is flat. That's an extremely low percentile. You can go back as far as you want. And then two, as Mike says, S&P vol is trading tight to realized, at least relative to the time series of S&P. I mean, look, I've been in equity derivatives for 30 years, and we would look across the pond at folks trading FX options, and I'd hear people complain about buying Eurovol at 7 when the realized was 7. I'd say that's the most glorious setup you could imagine in equities. We were used to paying so much in spot vol risk premium, in roll down. So, all things considered, it's in some ways a better deal, even as it's been hard to make money owning vol this year. The vol risk premium has been on the tighter side.
Yes,
again, relative to history.
And, exactly too, going back to the empirical component, right? And so this is hitting exactly the point that Dean is highlighting, which is this is the realized point beta, right? So I just want to be very clear, what we're looking at here is not the percentage change in UX futures or in the VIX. We're looking at the point change in UX futures of the VIX, which is a better way of normalizing, right? Because if the S&P falls 10% and the VIX is already at 50, you shouldn't expect it to double, for example, right? You should expect a point change of a certain amount. This was part of the underlying analysis that existed in looking at things like the Volmageddon trades around XIV. We'd gotten so low in VIX points and UX points that doubling and causing an inverse product to go to 0 was getting easier and easier. In contrast to what we had going into the Volmageddon events, which basically happened here, right? Today, we're sitting at the exact opposite side, right? We are at the lowest level, exactly as Dean was saying, of responsiveness of UX futures to the S&P. Now, today, obviously, is a bit of an outlier on that in terms of the responsiveness down. But even there, it's pretty crazy when you think about the fact that the VIX fell 10%, right? From 26 or so to, 23 and change, in an environment in which the S&P was up 6%, right? That's incredible volatility to the top side. And it actually, really speaks to, I think, one of the other features that Dean was highlighting, and I'm looking for the slide for it here. Give me one sec. Here we go. Nope, that's not what it is.
We'll get to that one soon.
Yeah, we'll get to that one in just a second. I wanted to show, that's not it either. Where's my skews chart?
Well,
there we go. There we go. So again, thinking about things that you don't often see, we're looking at the lowest level of skew, the premium that's paid for puts over calls in basically our living memory, right? This is, a return to the pre-1987 environment in which there's elements of smile returning, where it's perceived as the market is symmetrical in its behavior to go up and go down, right? That's a very unusual thing to see happen.
So let me go to our audience. I'll say I apologize. This is going to be a geek fest today, so it won't be as much fun as usual, I suppose. But I'll segue into two things. One is, Dean and Mike, open-ended idea, like, what's the wrong price here? It could be a lot of things. It could be the level, it could be the skew, it could be a lot of things in the derivative market. And to Mike, I think now's a good time for the quiz.
Sure. Why don't we go ahead and actually post up that quiz? We have a polling question. The first one is, who has better hair? Oh, no, I'm sorry. It's the move index one. All right. So the move is near a record, yet the VIX barely 10% over its long-term average, despite a 20% decline, because Fed policy, lack of demand, retail is still bullish, inflation, or other. And feel free to comment in the questions about other. And we are going to spend some time talking about the CPI dynamics today as well. All right. We have our votes. I'm not allowed to vote.
Wow.
Wow. The audience is as confused as we are. So Fed policy, lack of demand, retail is still bullish, all scoring above 20%. Inflation is the lowest. I'm actually a little surprised by that. And other. So I'm interested to see what some of the other comments are as well. Please dump those into the Q&A or into the Q&A area if you have them.
So Dean,
Harley, are you surprised by that? What's your reaction or your answer?
well, I already gave my answer that it's just realized volatility that's driving it, as opposed. I mean, all of these things basically, combine to create the story. I mean, it's rates are the uncertainty here. You and I go back and forth on rates and inflation, and we've had Rosie and Lacey on. We all haggle it out. We don't know what rates are going to do. I think everyone's much more comfortable with the range of what SPOO's earnings might be and what the PE might be. We could probably define that. Rates, they could be 2, they could be 8. We'd all be like, saying what's possible, I suppose. Going back, Dean, open end, like, what's the wrong price? When you look at the world here, what's the wrong price?
Yeah, it's a really interesting question. And I'd say if I were going back 6 months and looking at some of or even a month ago, just looking at some of these cross asset metrics, spending time just trying to appreciate the implications of British pound vol at 25, the spiraling higher of gilt yields, the move in the 150s. That to me imposed vulnerabilities on the S&P that just felt like it wasn't too far from becoming something that, how asset prices can misbehave. It can happen really quickly. They're hard to put back in the box once it occurs. And so, my sense was I felt like the S&P was realizing 30 and the VIX was at 30. And you have these cross asset metrics that really speak to some version of potential chaos. That felt to me like, okay, I can carry these S&P options flat to realized. Now I know 30 is a high number, but I'm realizing it. And so that felt a little wrong to me. As we come back down here and things have definitely retreated, I think we're away from some of the potential cliff outcomes, bad outcomes from an asset price standpoint. So I think that's where I would start, is just this idea that, I don't think there's enough risk premium. This goes back to what we were talking about. Yeah, the VIX is high in historical context. You said the long-term average is maybe 19 or 20, but the realize is more than compensating you for it. And so if I step back and I think, do I want to own the market versus rent it? Either way, upside or downside, I think S&P options, the index option, gives you a better deal than it has in quite a long time. So I don't know if it's the wrong price. I think it's a favorable point of entry, just in terms of going long or short.
So to me, again, one of the interesting things that's happened is how this is actually occurring. So this is, Dean and I have been spending a lot of time talking about some of these dynamics. He had included in his slide deck to investors a chart that was similar. I've simply taken it back further in time. One of the reasons why we've seen the VIX retreat has been, and this shows up in the skew chart as well, a collapse in the demand for left tail protection. Right. And at the same time, we've seen a rise in the demand for right tail protection. So just to orient people to what we're looking at here, these are the CBOE's correlation at delta indices. What that means is that it's the implied correlation of an index option that is struck at a particular level of delta, right? So a 90 delta would be a deep out of the money put. These are all expressed in call terms. A 10 delta would be a deep out of the money call option. Flip it in your head because they're expressed in call option terms. Usually there's a significant premium associated with tail protection, and that tail protection carries a high degree of correlation in it because what you're protecting again is the systematic event, right? The systemic event in which the risk is not hitting Apple or NVIDIA or Microsoft, it's hitting everything all together, a 9/11 or a COVID crash, et cetera. What we have seen is, interestingly, a collapse in demand for that type of protection and an explosion in demand for the call side of the equation, the 10 and 30 delta strike correlations. In other words, my read on this, Dean, is that people have reduced their exposure to the point that they think they really don't care that much about the downside. In other words, cash balances are high. and grosses are relatively low for the hedge fund community in particular, which matches data we're seeing elsewhere. But people are playing with very short dated call options to basically protect against events like today. Does that sound like a reasonable interpretation of this analysis?
Well, listen, when Harley said we were going to geek out, boy, we're geeking out here on
Yeah, it's our
implied
specialty. We do this hard.
implied correlation by strike. Boy, yeah, I think, look, we're in the business of trying to ascribe cause and effect in our market. We wouldn't feel comfortable otherwise, right? So there's always got to be something we can point to, and there generally is. I think that's as good as any an explanation. There's other purported explanations for why especially the put side of the skew is kind of been dampened. Some of it is the realized vol on down days isn't gigantic. I think our biggest move down is 4% this year, versus a 20-odd% drawdown. That's on the low side. You go back to the other drawdowns of significance, you've always gotten a 5% move. If you're in the 15+% drawdown, you've always had at least one day of a 5% move. And in the context, as the convexity maven could tell us, big moves matter most in vol. A 5% move is worth actually a lot more than a 3% move, a ton more, right? In terms of convexity. So that's one reason. Mike, another one that's been put out there, and I guess you'd have to check with our friends at whether it's SocGen or BNP, is some of these structured products that sit atop the market, the overlay of complex Greek exposures that, again, this is the explanation that's put out there, is that dealers have sort of gotten longer vega on the way down. So their books are fortified by these cliques and all the callables and so forth. Again, an explanation. I think it's hard to prove one way or the other, but it's an explanation. I personally have found it a little perplexing. I think there's plenty of risk out there, and the market has just been, well behaved on the downside. The other thing I'll just say is there's not a bid to puts because puts haven't worked. I was running some back tests, and if you're buying systematically 1 month puts on the S&P, if they're struck any lower than 7% out of the money, you're down on the year. That didn't even include today. Then you're definitely down on the year. Yep. So think about that. A 20% drawdown, you've got this innocent hedging strategy of buying 1 month, 7% out of the money puts, and you've added to your losses. If you're buying VIX calls, you've added a lot to your losses. Those have been really dead money. So people run away from things that don't work. That's just another example. But I think the underinvestment is a good explanation as well.
Couldn't we go and Dean, we've seen this huge growth, and I will tell you that we're involved in this stuff of doing these structured ETFs where they might buy a 5 or 10% out of the money put and then sell a 15, 20% out of the money put. So they're just trying to capture that 10, 15% gap in there as opposed to the big, macro hedge. If you have these trades going through at 10, 20,000 at a clip, you're gonna flatten out the skew from the 10% out to 20% out and push that down. And since the VIX basically is measured by adding up all the strikes, if you flatten that these big way out of my tails, you're going to bring the VIX down and also just bring the overall, vol service down. So, I'm thinking that's what it is that people have gone to doing put spreads as opposed to doing straight out puts.
So so I think there's truth to that, Harley. But again, if I look at the characteristic, and I apologize, I just realized that this chart had not been shared properly, or at least I don't think I shared it properly. If I look at what's happened in that skew collapse, it has actually been an increase in correlation for the calls that are the primary driver of the skew collapse. It's not that the tails on the left side have gotten radically cheaper. It's that the calls have gotten significantly more expensive on a relative basis.
Well, that will bring the VIX up, actually.
No, I understand, except for the fact that the way that it's calculated gives weight to those tails. So yes, there has been modest deterioration on the left-hand side, but the really unusual feature, you can see here, this is the year-to-date component, right? The left tail, the correlation is not that crazy. The individual stock component the individual stock vol has fallen as well. And equally important, actually, some of the highest weighted stocks that had super high implied volatility, some of the high flying technology names like Snowflake, et cetera, have been reduced in their relative weighting across some of the indices, right? So those things all factor into this underlying dynamic, the changes in the weights, et cetera. But really the distinguishing characteristic for the year to date, I would argue, has actually been the bid for the calls, the general selling of index and overall positions by discretionary funds. We see this in the positioning data, matched by protecting that top side, effectively going delta zero, using a delta one instrument, going to cash for their risk reduction, while then turning around and buying the call. That's just what the data says. I don't know that that's the driver. As Dean was saying, there are multiple explanations for it. One of them that I highlight that I think actually does play a pretty meaningful role is our general emphasis on the longer dated stuff, the world that we're used to operating in, the 30-day, the 90-day, even the 1-year options. The deterioration in their relative importance to the market feels like something that's really worth hitting. And we don't have the slide here, but there's 50 of them out there that show the share of transactions, the share of volumes that's hitting the market now in terms of 0, 1, 5-day to expiry options that actually aren't even captured in the skew analysis, right? So the CBOE's measure of skew, for example, only includes options of a week or more in duration. Dean, can you give some thoughts on why both retail and institutional are moving to the 0 and 1-day sort of environment?
I think that a couple of things there. This really became a post-pandemic phenomenon. I think people were home, Robinhood was free, and people were flush with cash, and the market was going up. And I certainly by August of 2020, there was a measurable positive feedback loop between a stock price and its implied vol. The circularity of it was pretty easy to see. A retail investor, or 100,000 of them, buy 1 or 2 options at a time. In aggregate, that's a pretty big print, right? That's a 200,000 lot. They buy all the same things. So the likeness of the trading strategy is, what's your prototype? It's a 2-day or 1-day, increasingly, upside call on Tesla, on NVIDIA. And the deal, maybe it's 20 delta, 30 delta. So what happens? The dealer buys 30 delta. The stock goes up, right? We know that was a raging bull market once the pandemic ugliness cleared. And so the dealer's got to readjust his or her hedge, and they have to do so in a hurry, right? And so the gamma intensivity of this stuff really can lead to the rental becomes ownership as that delta climbs and climbs quickly. I remember from November of 2021, NVIDIA went up 35% in a month, and the vol climbed 30 points. You might say that's okay for a small stock. For a $400 to $500 billion market cap stock, that's just not normal, right? That's a supply demand imbalance. And just to give you some stats, fresh stats, there's a lot of charts out there talking about the notionals traded in put options, alarmist type stuff that we've seen going around on Twitter. And I think a lot of it is misplaced. It's not, these instruments are trading as stocks. People are trading into and out of them very, very quickly. They're day traded. They're not really insurance in the sense that the three of us would think about insurance. For Tesla, 61% of the overall volume today expires tomorrow. Okay. 20% expires next week, which is the normal November expiry. So 80% expires within a week, 60% expires tomorrow. And in the SPYs and Qs, 50 and 40% respectively expire tomorrow. So these are very fast, high gamma, high decay bets. They pay off quickly, but it's hard to get away from the difference from even 10 years ago. The risk profile of the market is much less vega, and it's just much more ultra short dated gamma, right? It's being hedged algorithmically. There's not a guy sitting there thinking about whether to rehedge. It's just all a big model that interacts electronically with its end users.
Dean, are
So,
you
so
implying?
I want to dig on that observation that you just made for a second there. So when you said it's not a guy and there's delta hedging, and one of the commentators made this observation as well. Most institutions, Simplify included, that are using options for hedging purposes or even for speculative purposes, the whole point for us is not to delta hedge. Whereas if you flip that on its head and go to the dealer or go to, to the originator, the market maker who's creating this option, and this is one of the things you and I have talked fairly extensively about, that the consolidation in that industry means that there's far fewer players making markets, creating options, et cetera. People have heard me say this before. I just want to emphasize, like, the ideal situation for a market maker or a dealer is Dean wants to buy an option, I want to sell an option. They'll cross the two of us and take the bid-ask spread between the two. They'll identify effectively those two trades as efficiently as they can. But if I want to transact, they will create options for me synthetically using a put call parity or delta hedging type approach. It's not always exactly that easy, and they're significantly more sophisticated at this point. But they are not trying to take a directional exposure against me. They'll simply cancel that out. One of the ways that they deal when we talk about implied volatility, one of the ways they deal with that imbalance that can come through is by cranking up implied volatilities, effectively raising the price to a market that is demanding more supply. Dean, do you see more sensitivity on the single name equities because of this consolidation dynamic? Is there more of a willingness to respond by hiking as compared to putting balance sheet at work?
Well, I think that's a hard one for me to comment on. One, because so much of the volume in the singles, especially for this subset, I'd put Tesla in there, I'd put BABA in there, maybe Meta's in there. It's so front month and front day, I guess I would say. The meme episode of Jan and let's call it April of 2021 was obviously a pretty extraordinary period of time. And, I would have thought that upside bid, right? The hedging nightmare that comes from watching a stock go 20% up and then 40% up in a single day. I thought that would have been stickier in terms of the way in which these option prices materialize than it's been. That episode, I don't want to say it came and went, but it certainly died down. It's a little bit more at the index level now. But again, I think that the important point is that differentiating these extremely short dated, it's not a week option, it's a day option. The gamma and the Greek profile of these things and the decay and the sort of way in which the dealer, if it's trying to offset its risk, which it generally is, needs to trade in and out of the stock, it's a very unique beast. And I don't think it's something you could accomplish on a person-to-person basis. You've got to be facing against a machine that's got a hedging protocol that's built into it.
Dean, do you think this increase in, let's call it 1 week on-in options, do you think that's a sign of cowboy, cowgirl gambling? Or do you think it's more a sign of more sophistication of the users of options and derivatives? So I'm thinking back, like in the mortgage market, it used to take, if you had it took like 2 points. If you had an 8% mortgage, had to go to 6 before you'd refinance because you weren't that sophisticated. You didn't want to go to the bank. And by the time you got to the early aughts, you could refinance at 50 basis points. People got used to going to the bank and doing it online. They got better at the financial process. I'm wondering now, is it really gambling going on here? Bitcoin people going into options, or is it maybe people are smarter?
Yeah, so I want to answer that. I want to start with just a very quick, just remembering a story. So I want to say it was 2004 or so, and listed options were monthly options. They didn't even have weeklies back then. Right. And so we decided, we was at Bank of America at the time, we were going to start trying to trade OTC one-day options. And it was the first recognition, I think this is a good day to talk about this, because it was first recognition of event risk at the index level. So there was non-farm payrolls was coming out, and we marketed a 1-day OTC option on the SMH. Okay. We pumped up the vol, and we got a couple people to do it. Now, one of which called us back looking for the ticker to put in his system. And we had to tell him, listen, dude, you just bought an OTC option. This is not a listed option. So, lesson learned there. That was an undo. To your direct question, Harley, I think most of it's gambling. However, today tells us, right, we're here talking on a 5+% up move. It's not coming during a crisis period. Mike made a great observation that's got to be unprecedented to start with a 20-odd VIX and get a 5% move. I don't think there's any
up move, right?
5% up move. I don't think there's any precedent to that at all. And so, Harley, your question is around, yes, there's some gambling, but also institutionally, people recognize that we live in a highly event-driven market, even at the index level. And so I've said that FOMC and CPI, they've become earnings days at the index level. Earnings are special. 4 times a year, a company tells you how it did. The realized vol on earnings day is 3 times that of a non-earnings day. The market gets it. It's always priced, and it understands it both on a relative and absolute basis. So implied move for Procter & Gamble is much smaller than the implied move of Netflix, right? It's a bigger amount of information and reaction. Today, the implied move on the S&P was very high, but it turned out to be way too low. But the market gets it. If you're trying to hedge yourself, buy the shortest dated option you can, because that's where the action is. And it just speaks to the very event-driven, even at the macro index level, nature of this current market. So I think it's a combination of both.
I do think, Harley, I think one of the interesting things is the general view that, it's never different this time. And then simultaneously the question of, are people just getting better and smarter, right? The dynamic of the very short dated, if we use a Ken Arrow complete market framework, right? Theoretically, we should have options that are available for every second, every day, that allow us to express bets in a truly seamless fashion. I think the challenge, and this goes back to many of the things that people hear me talk about as well, is that a lot of those models assume that markets are largely frictionless. Right. So if the behavior of the market is increasingly influenced by people placing shorter and shorter bets against people who want to not take that bet and simply behave in a market making fashion, right? It's genuinely true that if you want to bet that the Steelers are going to win the Super Bowl and I want to bet that the Steelers are not going to win the Super Bowl, we have a zero net trade. We can cancel each other out. We have no influence on the outcome whatsoever. But if we express that bet in the stock market, we are actually influencing the market, right? And that I would argue, and we have rules that are very clear about why players cannot bet on players and coaches, and those affiliated with the NFL cannot actually bet on games, precisely because they're in a position to influence things. When we're participants in a market and we're capable of influencing them by virtue of placing the bets and the hedging of those bets, this is absolutely changing the market. Whether that's a good thing or a bad thing is something that we can debate, but this is absolutely, the evidence is really very painfully clear that we are physically changing the market in a meaningful fashion.
I'm not sure buying calls on Amazon is going to take their earnings up, by the way, but maybe it does.
But I don't think it has any influence whatsoever on Amazon's earnings, except for the fact, this is a pretty far afield one, although we saw an example of this with FTX today. If Amazon is able to use its appreciated stock to pay its employees and not report that as an expense because it pays its employees less than it otherwise would in cash expense, absolutely, we're influencing Amazon earnings.
Okay. Changing topics slightly, a chart you put up before was the correlation of stocks to bonds. And This was something that we've spoken about for years now, the idea that the 60-40 portfolio works so well because one goes up, one goes down. So that's the positive correlation on this chart because we have to use yield versus
right. So
price.
This is just to orient people with this chart. This is showing the percentage change in the S&P against the percentage change in the 10-year yield if it's positive, it's saying that higher interest rates are actually correlated with a higher S&P. If it's negative, then it's higher interest rates are correlated with a negative S&P, and bond prices are just going to be the flip of that.
Yeah,
Now,
so bond prices, bond prices and stock prices go in opposite directions. So a 60-40 portfolio will be, will have less volatility. And
Right.
what we had proposed a while ago was that if rates get above a certain level, 3-4%, that correlation would flip, which it has done. So to kick over to you, what right now we're seeing, today we had stocks and bonds both up. So I guess 60-40 worked very well today. What are you seeing across different markets that you deal in as far as what's correlated, what's not correlated, where their opportunities lie, any trades you might put on using options or cross-market options?
I think that I don't remember a time in which risk assets, and let's just use the S&P, credit-bearing assets, those sorts of assets on one side, as so driven by rates and the dollar. It's mind-blowing to watch. If you look at the press conference from last week, that behavior of the way in which the dollar and rates were just wrapped around the S&P. If you look at 8:30 this morning, the exact same thing. I had mentioned that we've talked about how muted the correlation is between the S&P and VIX, and of course they're still, pretty negatively correlated. I think it's about minus 66% over the last 2 months. The S&P is actually more negatively correlated to the dollar. I think that's just tells you all you need to know, that the dollar and rates are the keys to where we're going. And, you can kind of think about the outcomes from a quadrant perspective. So, the bad would be, especially in the context of the correlation environment we're in, would be rates in the dollar keep rising. That's just going to be awful for risk assets, right? That's where we were headed. We're now in the kind of good zone where rates in the dollar have declined and the S&P has enjoyed that decline, right? Then, and as you said, Harley, that's antithetical to risk on, risk off. So I think that's pretty interesting. I'm wondering how the pricing of correlation has shifted. So we know the realized correlation between, and you just showed it there, right? So we've got at least
so up on the screen, by the way, we have the correlation between the S&P and the dollar,
right,
to complement what we were just looking at with the correlation between the S&P and rates.
Yeah, so I think so we can use rates and FX in the same way. So if you can get your hands on a structure, a light exotic OTC structure in which the dealer credits you for that correlation, right? That negative correlation, that could be an interesting way of implementing a trade, trying to find, some degree of cost offset. I think, here's the other thing that's just, to me, fascinating. We know via put call parity that if you're long stocks, you can effectively mute your entire exposure, just do an at the money offsetting, you buy the put, sell the call. And what you're left with is a position in cash that you can basically become a lender of. And so collar pricing right now is simultaneously impacted by this flat skew we've been talking about, and the fact that rates are a real thing again. You're upwards of 4% now. So that to me is very interesting. If you're trying to dip your toe back into equities, a lot of people have been burned. There are some very simple, I'm sure Simplify has a strategy that does this, right? You've got an opportunity to enter the market in a risk managed fashion. You're not going to get all the upside. I'd argue you're not going to get all the upside anyway. We don't know what's going to happen with the degree of impact that rates at this level are going to have on the economy. So we don't know. There could be bad things coming. It could ultimately impact earnings. So I like having a hedged exposure, and I'm willing at the current pricing to sell off some of my upside. One, because I don't see a lot of it materializing, but two, I'm being compensated for selling off the upside versus paying for the downside in a way that is more favorable than it's been in 20 odd years. So I like the collar. I think that's a really basic, liquid, way of getting back into the equity market after a time when people have, they're pretty gun shy after a 20-odd% drawdown.
So Dean, when I look at this type of dynamic, right, it is one of the things that kind of jumps out at me, right, that where this pricing has historically been the cheapest, right, has often been right before markets kind of went on a tear, right? So
Fair enough.
For example, this would be the fourth quarter of 2018. This would be immediately after the March 2020 COVID events. Is the flip side of that the market is telling us that this bear is over, that the risk is really to missing the upside and not being able to get back in?
Yeah, I think that's a really fair point. And I just would be plenty comfortable in telling you, I just don't know. It's a really difficult, it's a difficult call, right? You can't get something for nothing in markets, and certainly options are efficient. I think what I'm arguing for is some version of the guardrails, because as I said, we don't know the impact of these high rates, right? We know how high mortgage rates are. We know what's should be coming to the housing market that could impact the economy broadly. There still remain plenty of tail risks with things like China. So we should be humble about what we don't know. I like to say with options, try to take what the market gives you. And the vol surface and the combo of rates and how that impacts collar pricing, it gives you something more favorable than it did. So your point is certainly well taken. This would just be a risk reduced way of trying to dip your toe back in.
Let me add something here just to go and double down on the geeky stuff. Be very careful about charts like this, because there's a big component of the interest rate. You have the skew, so the vol of the atom I put and call, then you have the rate. When you deal in derivatives, they price off the forward, not the spot. Now, Mike and I wrote about this, last year, the year before that you could use derivatives as a way to borrow money at, 0.25%, because the options were priced that way, because that's where, Jane or Citadel or Susquehanna would price it at. And that would make these collars really cheap, because you're borrowing money at 0.25%. Now you're borrowing money at 4.5%. And that's a whole different animal. And that's what's really driving this thing up over here. It doesn't make it good or bad, but it does change the underlying, economics of this thing. And that's why right now, as Dean's advising to go the other way, sell the call by the put, because basically by doing that, you're lending money at 4.5%, which is not the worst trade in the world.
Well, so I think, Harley, you're hitting on an important component. And yes, by the way, I actually agree with that observation. It's slightly higher at the 3-month point, right? Because you're actually on an annualized rate of interest. It's above the longer dated now. But that's not enough to drive this. It is, I guess, the easiest way that I would put it, because the level of the interest rate has not swung enough that at the 3-month point that's going to end up being the driver. I come back and say the same thing that I was saying before, that there has been a meaningfully substantive shift towards the demand for calls as distinct from the demand for puts. And absolutely agree with what you're saying, the row component and the extended row component after the move that we've seen in interest rates, particularly if you're looking at 1 year, 2 year, even 5 year options, which you can do in the OTC space, much less so and much less easily than you used to be able to. The pricing of those has changed remarkably. All right, just to put this in perspective, if I go back to 2020, where we had roughly a 2% dividend yield in the S&P and roughly 0% interest rates at the 5-year point, that meant that 5 years out, a call option on the S&P roughly would be struck 10% below today's call level. Today, that has completely flipped itself on the head, with the yield on the S&P around 2% and interest rates around 4%. That same strike is going to be 20+% higher. It's going to be 10% above, slightly more than 10% above the current spot, which means that relative to where we were before, you'd need to have basically a 25% appreciation in order to break even, right? So I absolutely agree, but I think interestingly enough, that would work in favor of what Dean is suggesting: sell the call.
Yes, exactly.
The put.
That's right. Oh, no, there's no question. The interest rate component is more powerful as you go out in time, but you'd be surprised, even when we got 3 months, going from a 0 rate to a 4.5 rate. I mean, you know, it's, if you add that on top of the skew, you get this.
Well, that's one of the interesting questions, of course, is how much of the skew component is actually being driven by this type of dynamic, right? People recognizing that instead of simply going out and putting money in stocks because there is no alternative. Again, another way to think about this is I go out and I buy high quality corporate bonds yielding between 5 and 6% as the base of my portfolio. And then I overlay a call option on the S&P against it. Right? That's functionally what, again, that speaks to the positioning and everything else. Like all of the things are basically telling us that people have by and large come to the conclusion that the TINA world, there is no alternative, has been replaced with there's a lot of other interesting stuff to do. Right? As long as, by the way, and that may be part of what actually is transpiring today, as long as I believe that the Fed is going to maintain a high interest rate policy, I would be foolish not to take advantage of the opportunities that exist in fixed income is kind of the easiest way to think about what I think a lot of what we're seeing is.
Yeah, I think that's an interesting one, right? So again, we can use risk on, risk off. That's typically stocks versus bonds, but the credit spread component of a corporate versus the interest rate component typically are mitigating each other, right? So you get a big washout in the economy and corporate earnings decline, risk premium goes up, but duration rallies. So your credit spread widens, you lose on that, but you get it back on the rally and on the bond part, the risk-free part, right? So those have been going the same way for the imposing itself from a loss standpoint on investors. We know how bad ETFs like the LQD have done this year, but you also have a circumstance where, like today, you see the pressure point comes out of the market, rates come down, and that's the release valve for credit spreads to come down as well. And so, that one's a tricky one because one of the things we'd argue is that credit spreads just haven't shown enough of the damage with respect to where they could go. You go for, again, exclude the pandemic, exclude the GFC, and you look at, real recessions, and you certainly have had much more credit spread widening than we've had so far in 2022. That could be coming, it might not be coming, but that's where I have a little bit of pause where, let's suppose you get a bad recession, it's a big risk off. I do think ultimately the bond market's going to rally on that. So you will see a return of risk on, risk off, stocks down, rates down, and credit spreads wider. It's hard to know if that'll happen because you'd have to have a pretty concerted risk off. And from a corporate bond perspective, which side is going to win? Corporates have had a lot of duration in them. That the duration risk has almost dominated the credit spread risk, at least in the low rate cycle. So it's sort of difficult to know what you're rooting for. Rates, if it is a true risk off, risk in the classic sense, I'll call it, duration rallies, but credit spreads widen, it's hard to know which wins on that, right? So it's a tricky one to call.
Well, I think that's particularly true. I mean, I was having a conversation with our mutual friend, Danielle DiMartino Booth, about an observation that she had made about discounted bonds, right? So high quality bonds trading at a discount as a measure of credit stress. And, the interesting thing, I think, Dean, that you just hit on is that most of the bonds that are trading at a discount and a meaningful discount are at that discount because of the duration component, not because of the credit spreads. Right now, there's all sorts of tricky components around adjusting for that and recognizing, that a portion of that can be interpreted as a credit spread due to the nature of the curvature of those instruments. But by and large, we are not, I've tried saying this elsewhere. It doesn't feel to me like we're priced for a recession at all. What we've been priced for is a sell-off in duration, and that's influenced the move index. To Harley's point, we're realizing high levels of volatility in rates. It also, to a certain extent, has driven a de-risking of the market as TINA recedes, right? To me, it just seems like the simplest explanation for what we have seen on a year-to-date basis, and I should put a chart up that shows this, but I'm going to pass because we got others to get to, is to look at the dynamic of what's happened to if you think systematically about a portfolio that is 60-40 bonds and equities, if your bond portion sells off because the Fed hikes interest rates, what do you have to do? You have to sell equities, buy bonds. Fed hikes interest rates, the bond portion of the portfolio sells off. What do you have to do? You have to sell equities, buy bonds, right? That feels like a much more robust explanation, and it almost perfectly explains what we've seen on a year-to-date basis, where we just haven't really seen the evidence of that sort of structural outflow that you might expect to have had given the pandemic aftermath and everything else. Like I don't know if you've seen anything different, Dean, but I'm still not seeing the evidence that retail is quote unquote tired or out, other than in the most speculative stuff.
I would concur. And it's almost as if, you start with the most speculative of the speculative asset classes. So let's use crypto, and then work our way down to SPACs. And then you start to hit spec tech, the software companies that trade at sky high, PE ratios and so forth. And then you sort of start to cut deeper, into the market, right? So, one thing I would say, and Harley asked me just in terms of things to do, I think it's always fun and important to play what if, and try to be contrarian to the extent you can. And I think it's easier to be a contrarian when you've got more limited dollars at risk, when you can kind of stake a defined bet on something. And so something that you've been looking at, which is just trying to find these names that are so out of favor. So we're staying US equities for a moment, and pick out some of these just bombed out tech names. Maybe Meta is an example. I'm not a studier of that business model. Zuckerberg seems hell-bent on moving to the metaverse and moving the whole company there. That's okay. But you have a chance to maybe play contrarian, and you can do that through some interesting option structures. You can do, slightly longer dated leveraged call spreads, like a 1x2 call spread, or a, even a call fly. So this way you truly know your risk. So, buy an upside call, sell 2 further upside calls, and then cap off your risk. Give yourself plenty of time. And it's been interesting. I'm looking at that because it's the opposite of a trade that we had thought about that's worked really well this year, which was doing a staggered portfolio of put flies on the triple Q. So not a lot of vol exposure, cheap bets that don't really do a lot on the mark-to-market basis, but they kind of accrete value as the market slides down slowly. And so what I would say is, if you're trying to get back in, you don't want to blow a lot of premium, give yourself some time and try to use some option structure that you sell off some parts that you don't really think will materialize, right? You don't get something for nothing, but try to structure the bet so you've got adequate time and you haven't spent a lot of premium. And some version of a call fly might do something like that.
And do you have any, you may not, any views, like fundamental economic views on rate or inflation or stock? I know Mike is dying to go say how the 4% contribution of used cars basically drove down CPI today. Do you have any big thoughts about that?
So we work closely with Barry Knapp, who runs Ironside's Macro, a brilliant thinker on the Fed and the economy. And one of the calls that we just did, we were looking at the shape of the curve. And this was just before today, but you had the policy rate kind of peaking in March, April, May, sort of 4.7 to 5%. And then it starts to, ease back down. So you have these implied cuts for 23, 24. And Barry said, I would take that hump and just turn it upside down. Basically making the point that the path from 8 to 4 is relatively in sight. You can kind of see it coming. Again, easy to say today because the data really corroborated that. Used car prices, some of the quirkiness he's identified in health insurance premiums, but you're going to get stalled out late in 2023. You could get stuck around 3.5%, 4%. And then the question is, well, then what? If that's the case, does the Fed really want to get to 2%? Because that could be brutal. Trying to go from 3.5 to 2 could be a lot harder than going from 8 to 4, I think is his point. And I think that's an interesting it's long dated. It's not exactly actionable today or tomorrow, but I think it's an interesting perspective.
I mean, unfortunately, that's kind of the take that I'm taking as well. And yes, Harley, I did notice that the used cars that we started off 2022 with me saying that they had peaked in price and they were coming down have in fact now turned negative, and we did manage to tag the peak of the used car pricing. But you know, part of the reason why you've heard me be so vociferously against what the Fed has done is, unfortunately, I think that Barry's analysis is probably pretty accurate, because what we did was we killed supply, far more so than we've actually killed demand. And as a result, we're going to face structural challenges in housing markets. We're going to face structural challenges in infrastructure. We're going to face structural challenges in energy as we move forward in 23, and as eventually the world starts to recover, right? I mean, right now, if you look around the world, the United States is about as close to functional as you get. You go over to Europe or you go over to Asia, and they're engaged in various forms of austerity as it relates to energy usage and everything else. As that begins to normalize, and as we try to actually pull ourselves out, like, now we are actually setting up for the Russell Napier sort of environment in which less and less activity is driven by the private sector with the objective of gaining efficiency. And more questions are raised before you engage in any project. Does the government want me to do this? Will the government provide me with a stable financing source, et cetera? I think that's going to be one of the most interesting byproducts of the behavior that we've seen over the last year and a half.
Well, I could listen to this conversation for another couple of hours, but unfortunately, we're going to have to wrap it up. Thank you, Dean, for joining us. And for everyone at home, you can follow Dean's work at macroriskadvisors.com. You can also follow him on Twitter at alpha_EX_LLC. And again, go check out Alpha Exchange on your favorite podcast app. Join us again next month as we host Ben Hunt of Epsilon Theory. And until then, take care, everyone.
Thank you very much.